HMRC have issued some very helpful guidance on the new Dotas disclosure of tax avoidance schemes, hallmark for inheritance tax. Now, this new hallmark is in addition to the premium fee and confidentiality hallmarks, but it's well worth spending a little bit of time on. The guidance makes it clear, and we all know this, is that if there is a requirement to notify under the Dotas provisions, the requirement falls on anyone involved in the promotion of the scheme. So what are the conditions in relation to this new hallmark? There are two. The first one is that the main purpose, or one of the main purposes in underlying the arrangement, is to avoid inheritance tax broadly through the use of a trust, or to avoid a relevant property charge under a trust. Also to encourage if you've achieved the reduction in the value of your taxable estate that hasn't needed a lifetime transfer, or you've avoided the gift with reservation provisions. So there's an awful lot of schemes that could satisfy that first test, and it's just as well that there is a second condition, which is that involved in the arrangement there are contrived or abnormal steps. So we need to get underneath that. What is contrived or abnormal to see just which schemes will and won't be caught. Again, the guidance is really helpful in this, in that it states very clearly that the ordinary use of a trust will not count as being contrived. And then HMRC and ordinary gifts won't be treated as contrived. And HMRC have given us a few helpful examples. In fact, they've given us a list which I'm going to read from. Here are the things that won't count as contrived or abnormal. Ordinary gifts, regular gifts out of income, repeatable nil rate band gifts, that's using the nil rate band every 7 years, lifetime transfers to a bare trust, disclaimers and deeds of variation, exempt gifts to a spouse or charity in a will, disclaiming a benefit under a will, really useful, investing in shares that qualify for business relief. There'll be many advisors who'll be happy to hear that. Gifts of land with continued donor use, paying a full market rent, one of the ways of avoiding gift with reservation that's provided for in the legislation. Gift of an undivided share of a property subsequently used by the donor and the donee, another way to avoid GWR and residential property. A non-resident, non-dom transferring money from a UK bank account to a US dollar account so that it doesn't represent UK cited property. Non-dom transferring non-UK cited property into a trust before becoming deemed dom under the new rules. Making a distribution from a discretionary trust before the 10-year anniversary. Establishing a gift and loan trust or an ordinary loan trust. And loans to companies and other entities from which the lender cannot benefit. All really, really helpful and reassuring. And if that's not enough, there is also the so-called established practice exception. Now, this is really important in relation to the financial services sector in connection with discounted gift trusts, because they aren't on that list. So the established practice exception, how does that work? Well, basically, an established practice is where you've implemented a proposal which has been implemented by related arrangements, and what you've done is substantially the same as the related arrangement. So I'm going to read again. A related arrangement, importantly, is defined as an arrangement which was entered into before the 1st of April 2018 and at the time they were entered into, accorded with the established practice of which HMRC have indicated their acceptance. So basically, if the scheme existed in the market and people entered into the scheme before April 2018, and what you do after that date is undertake a scheme that is substantially the same as that type of scheme, then you're going to be all right. Now, it needs to be the scheme that you enter into in the same form as the scheme that was promoted and entered into before 1st of April this year. So care would need to be exercised if, for example, in a discounted gift trust, substantial changes, meaningful changes were made to the terms of the DGT. We need to ensure that it's the same form as it was marketed in and entered into before the 1st of April. So this guidance, I think, is exceptionally helpful. It gives an awful lot of reassurance that notification is rarely, if ever, going to be required for the sort of schemes that are used in the financial services sector. And as I always say, there's a really good bulletin on this within TechLink.